Stock investors better be concerned about this. You sure about that? You sure? And the is the bubble, and it's just so dumb. So I'm just going to show you something here first and foremost. This is the U.S. market is experiencing the most extreme valuation, both absolute and relative terms. This is a 12-month forward PE ratio, what we're expecting for the next 12 months, all right? And what you'll see here is, going back to 2003, this is right here, the median PE, right about 16. Right now we're at 21.4, all right? Way higher than the median, going back to 2003. And just hold that little knuckle in there. Nugget in there. Knuckle. And you can see quite variance there. This is the U.S. U.S. without tech, 20.7. That's our PE, our forward PE ratio. And you can see well above. Oh, but we got the world well above its last 20-year median PE ratios. Japan, well above. World X, the United States, well above. Europe, well above. The emerging markets, China, United Kingdom is right there. So anyway, you can see the whole world is well above the last 20 years in terms of forward 12-month price earnings ratios. All right, so does that like, oh my goodness, U.S. stocks are doomed? No. Higher valuations may be justified because of return on equity. Interesting. So here's the median ROE, return on equity, for every dollar you put in equity, how much are you getting back as a rate of return? You can see right here, our median is about 16.5, 17. The world is about a little bit under 14. But we're actually getting right here, our ROE is 21.3, significantly higher than the median ROE going back to over the last 20 years. And then look at this here. Check this out. The current ROE for the UK is right back where it's been over the last 20 years. The current ROE for the emerging markets is right back where it's been for the last 20 years. We are getting significantly higher return on equity than any other country out there by far, but nothing even comes close. Look at it. We're at 21.3. These guys 15, 14, 13, 12. China 11.8 and Japan 9.8. We're dominating. And that's why we have higher PE ratios, because you're getting more return on equity. Well, how could that possibly be? Well, check this out. Because our tech stocks are trading at relatively higher than historical valuations, but still not nosebleeds by a stretch of the imagination. As NVIDIA, 24-month forward PE. Now, this is contingent on analysts getting it right, and they don't all the time. That's just a fact. So you can make the argument that the analysts are wrong in projecting their future profits. I get you, but still, that's what our forward PE, 26, 27, 29, 20 for Alphabet, Google, Amazon 25, 21 for Meta, and then 135 for Tesla. That's a magnificent 7. Here's the tech bubble, though. 50 for Microsoft, 100 for Cisco, 42 for Intel, 84 for Oracle, IBM, Lucent. Remember Lucent? Nortel. Is Nortel even still around? Here we go. The Japanese bubble in 1989, 100, 150. So the point being is, our 24-month forward PE ratio is 26, and the tech bubble is 52, twice that. Japan was 67. The Nifty 50, remember that, was 34. Anyway, point being is, at the end of the day, we are not highly trading heavily over value relative to the earnings. We're just not, and especially relative to the Nifty 50, the Jap tech bubble, the Jap bubble, or the tech bubble in 2000. Just not. But it gets better. And here's our price to earnings growth. A little up on the high end, but not significantly high. I mean, look at that. Here's 2008 crash. Here's 2020 crash. We're high, but not significantly high. In fact, we're way lower than we were right here. Price to PEG, price to earnings growth. So not huge valuation. The U.S. tech sector, price to earnings growth, where the valuation is divided by the historical earnings, right there. I mean, we're just not through the roof. Now, what does that mean? I mean, again, this is, if we're looking at PE ratios for forward-looking, they could absolutely be wrong. But these are backward-looking. Price earnings growth with a valuation divided by historical earnings. So we're 1.7. It's not through the roof, man. It's just not. Here's the tech bubble. Here's 08. And here's 2015. Not sure why that had that big climb. But anyway, be as it may. It's not... Now, we got pretty significant price to book right here. I mean, it's higher than it's ever been. But then our ROE, return on equity, is higher than it's basically almost ever been, too. So, You can make a case, hey, the price to book is way through. Well, in tech stocks, what's their book value actually? I mean, I got a sneaky suspicion if you looked at tech stocks books, their price to book ratio is going to be higher than like consumer durable companies and whatnot. But anyway, all right, so all that's good. So check this out. So we have good valuations relative to earnings, unequivocally. We're not in bubble stretched by imagination, but it gets even better. Check this out. So I went over here. I said, hey, what is the S&P 500 earnings, the PE ratio right now? And as of November 7th, and we're at November 8th, it's 30.38. Oh my goodness, Josh, that's way high, way high. We're bubble-ish. Then look at January 2021 is 36. Huh. Would you have bought in January 2021, even if you knew 2022 the market was crashing? Of course you would. Because we've had amazing run-ups over the last couple of years. Even if you buy here, you're not freaking sitting on a bombshell. You got crushed a little bit, a regular bear market, but you made that money back in droves. What gets me interesting, look at this. In 2000, there's our 1999 and 2000 right there. There's 29 as our PE. That's what everyone's going to say. See, Josh, and then what happened next is, we had the down market from from 2000, 2001, and 2. So in 2000, the S&P was down 9, 2001 is down 11, 2002 is down 22%. So there's your S&P 500 PE ratio in 2002. Down 22% we were that year. Again, another bear market, but not anything extraordinary, especially when the PE ratios were so high. Look at that. 46. That's a bubble. But guess what happened? Even if you bought in January of 2002, yeah, you were down 22% that year. And you were down in about another 10% in Q1 of 2003. But you missed 9 and 11% respectively. And then you just boomed. Oh, but you said, but Josh, look at 2008. The S&P PE ratio is 21. Is that over the top? No. Then what happened in 2008 and 2009? Pablo. So the PE ratio is 21, well below what it was even in 2004. So you're, I can't buy. And then in 2009, January 1st, 2009, you're like, I can't buy. Look at that PE ratio is 71. I can't buy. Too high. And then you proceeded to miss the biggest boom in the history of mankind. Big mistake, big mistake. And we go back down to, let's go to 73 right here. 18. You're going to say 18. That's too high, too high. Really? Really? I mean, comparatively speaking, now it might have been back then, but 18. You bought into a bear market. It was down like 44%, but are you going to sit there and say it's too high? And then look at that, 11. And then 8. That's low for sure, but you're like, okay. But then again, we look back right here in 2009, it's way too high. But yeah, if you bought 2009, you freaking missed. Other than Q1 2009, you missed the market decline and you made money hand over fist. Crazy. And then you look right here, where we are now, 30. So I just want to show you this. Check this out. This is the PE going back to 1965 versus the 10-year treasury. So here we are in 2002. The PEs are so high, better not buy it. And you proceeded to just have your PEs go down, not because of price collapse, but because of earnings growth. PE was too high in 2009. Then you proceeded to have the PE come back down, not because of price collapse, but because of earnings growth. I mean, so here's your comparative. You can buy the PE ratio right here of the S&P 500 is about 30 or so, give or take. And then the 10-year treasury is yielding at 4. All right, so here's a 10-year treasury in 1980 yielding at 15 and a quarter. Here's a PE at 8. That's a great time to buy, but did you? Here they're merging right here in it's probably 1974 or so. And again, if you would have bought into a bear market, but you made bank ever since. But here's the fun ones right here. Right there's a big one, 2002. The PE's too high. PE's too high. PE's too high. And yet if you would have bought, you would have done okay. You would have done just fine. I just find it funny. If you would have bought in 2002, yeah, you would have got skunked here. But here's when the PE ratios were way through the roof. Why? Because the market collapsed so much. So in that case, the reason the PE ratios were so high is because the earnings fell off a cliff. Earnings came roaring back, and guess what? You made money. Anyway, this whole idea we're in a bubble is silly to me. I mean, it's just not a bubble. It's just not. We have positive earnings. Earnings are retaining itself relative to future projections. We have earnings in terms of people actually being employed at these companies. As long as you have earnings, you're going to be fine. Now, if the PE ratio gets through the roof, a la the Nifty 50, the tech bubble and all that stuff, yeah, you might get worried. But right now, it's just not there. It's just not there. So again, at the end of the day, the alternative investment would be the 10-year Treasury, and the 10-year Treasury is still only yielding 4% right now. And you got to pay tax on that money. So you're like, might as well take the risk with a higher, inflated earnings, but certainly not a bubble yet. It's just not. All right. God bless. Love your thoughts. Smash that like button.